Lately, I've been putting out a lot of videos covering Alibaba. When two of my favorite investors, Monish Pabrai and Charlie Munger, both invest in the same company, my mouth starts to water. Alibaba is such a complex company, I'm not sure that I'll ever understand every single facet of the company. But I've been doing a lot of research and a lot of reading, and I'm starting to think about what a reasonable valuation for Alibaba might be. In this video, I'll briefly cover some of Alibaba's core assets, such as its e-commerce business and its cloud business. And I've got a special guest that I'm really excited to have on the channel. Frank from the Investing with Frank YouTube channel is going to come on and provide a valuation for Alibaba. I'm always learning from Frank's videos, and I'm really happy to have the chance to work with him on this one. His investing philosophy is very similar to mine, and I'm really looking forward to collaborating with him more in the future. If you want top-notch investment analysis, definitely go and subscribe to Frank's channel. I will have a link in the video description below. So let me know in the comments below if you enjoyed this collaboration with Frank, and we'll be sure to put out more investing videos for you all in the future. Before we get started with the valuation, let's dig into a brief overview of Alibaba's business, because I don't think that any valuation is complete without at least a little understanding of the business. In the book Alibaba, the House that Jack Ma Built, author Duncan Clark describes Alibaba's business as the Iron Triangle. In light of some ongoing changes with Alibaba's business, I might change that shape to be the steel square instead of an iron triangle. The three angles of the Iron Triangle are the e-commerce business, the logistics business, and the financial business. But more recently, one of the key components of Alibaba's business is its cloud computing business. Alibaba has its hands in a ton of different businesses. As we can see, the e-commerce business makes up 66% of Alibaba's overall revenues. The two most notable e-commerce platforms that they have are Taobao and Tmall. Taobao is the home of millions of individual storefronts. The great thing about Taobao is that it doesn't cost the merchants anything to set up their stores. Jack Ma had a great vision of making Alibaba the company where individual entrepreneurs could make a successful online small business. Taobao doesn't charge any transaction fees. So Taobao charges no fees to open up a store online. However, they do charge and make a lot of money with their advertising business. This is similar to Google AdWords, where an individual storefront can pay to be displayed more prominently among the shops listed on Taobao. Taobao also sells services that help shopkeepers run and manage their business. They also provide services and management tools to help these shopkeepers increase sales and manage their business. The other core component of their e-commerce business is Tmall. Now, if we consider Taobao is here to serve the masses, then Tmall is here specifically targeting the growing middle and upper class of China. Unlike Taobao, Tmall does charge transaction fees and an annual membership similar to the Costco membership. Many US companies such as Apple, Nike, and Costco are all listed with stores on Tmall. Packy McCormick provides a powerful illustration of the scope of Alibaba's business. He argues that besides actually manufacturing items, Alibaba provides the services that help small businesses run their business from top to bottom. So he says that for every $100 in revenue, the merchant is left with $4 in profits, and Alibaba takes 96 of those dollars. Packy argues that this is evidence of the high switching costs of Alibaba's services. For example, why would a merchant move to any other e-commerce platform when Alibaba provides all the services that you need to run your business today? I've also seen some pushback on that idea that Chinese consumers and merchants are less trapped by the switching costs because they have experienced so much industrialization so quickly compared to, say, the United States. There are other subsidiaries in the e-commerce business, such as Freshippo and the new Taobao Deals, which is a direct competitor for Pinduoduo. But I think all of these pieces, while there's potential that they'll have great upside in the future, are not as core to the business as Taobao and Tmall. For the fiscal year ending March 31st, 2021, the core commerce segments actually grew 42% year over year. Now, for a company as big as Alibaba, those are just astounding growth numbers. One thing to note on the e-commerce side of things is that there is a lot of competition in this space. Concepts like group shopping, where companies like Pinduoduo really excel, Alibaba is still trying to catch up in those areas. Alibaba has been steadily losing market share in their e-commerce business, but that's kind of to be expected. For example, in 2013, they had 78% of the entire Chinese e-commerce market share. And as of 2019, that was 62%. As new entrants come into the marketplace, Alibaba's market share is naturally going to decrease. The real trick is whether or not there's going to be a cutoff point for when that decrease ends. Now, here in the US, when you hear e-commerce, you definitely think of Amazon. Now, in 2020, Amazon achieved about $500 billion worth of gross merchandise volume, which is pretty good. Alibaba's GMV is $1.2 trillion. That's over double of what Amazon did in a year. Next, I want to talk about the cloud computing business. Now, this business makes 8% of Alibaba's total revenues. So outside of the core commerce business of Alibaba, the cloud computing business makes up the most revenue for the company. Now, while 8% may pale in comparison to that 66% for the core commerce business, the cloud computing business is growing at an eye-watering 50% per year. And I think for the first time in the final fiscal quarter for this year, the cloud computing business actually turned a profit. And China is at the very nascent stages of the penetration for the cloud computing business into the Chinese business landscape. Alibaba is the 5th largest cloud provider in the world and easily the largest in China. They have about 50% of the market share, and that's about 3 times as much as the nearest competitor. So while the space is still small, they've been investing heavily in order to maintain and grow that market share. Alibaba's CEO has even said that the cloud computing business in the future will be the core part of Alibaba's business. This is one of the parts of Alibaba's business that I'm most excited for. I'm really excited to see how the cloud computing landscape ends up in China and throughout the whole world. Next, I'll touch on their logistics business. This company is a little bit different than some of its competitors, say Amazon or JD.com. Whereas Amazon and JD.com are both very asset heavy, they're investing in all of their infrastructure, all of the fleets, all of the warehouses themselves. Alibaba has taken a different approach. Cainiao, their logistics subsidiary, is more of a network. Cainiao is a platform that allows for the collaboration of logistics partners and couriers all to deliver domestically in China and in over 100 countries abroad. This subsidiary is making some huge headways in the way that delivery operations work. For instance, they have this little robot that gets loaded at a warehouse and then drives around the streets and notifies residents when their package is going to be delivered. Then it's basically like a moving Amazon locker. So really, Cainiao is another crucial piece of those switching costs that I mentioned earlier for Alibaba. For any merchant selling with Alibaba, Cainiao gives them access to cheaper and faster and more reliable logistics services for their customers. I would imagine that Alibaba wants this company to turn more into the veins of the logistics system in China and beyond. Cainiao is not that large of a piece of the business right now. It's about 5% of the total revenue for the most recent fiscal year, but it also grew at an astounding 68% year over year. And lastly, there's the more recently infamous part of the business, which is the Ant Group. Ant Group provides any financial service that you might need. They provide loans, financing, insurance, digital payments, and more. Alibaba owns a 33% stake in Ant Financial. Ant Group has been described as the largest privately held company in the world, and some were going to value it at $300 billion at its IPO price. That would have made it more valuable than most of the global banks out there. One of the core products of Ant Group is Huabei, which helps users finance their purchases on Alibaba's platforms like Taobao and Tmall. So if regulations put a cap on how much Ant Group is actually able to lend, then that might spell bad news for Taobao and Tmall's growth. Here's a pretty astounding stat for one of Ant Group's most important pieces, which is the AliPay platform. In 2019, PayPal processed about $712 billion worth of payments. AliPay processed $17 trillion worth of payments, and it's used by over 1 billion people. That makes it bigger than Visa and MasterCard combined. Traditionally, the payment processing business has been Ant Group's largest driver for revenues, but in 2020, that flipped to their credit business. But probably the most important role of Ant Group is to gather a treasure trove of data for Alibaba based on their users' transactions. So the more that users spend on the Alibaba platforms using AliPay, the better the products that Alibaba can offer to these individuals. After the failed IPO attempt, the future of Ant Group is a little more uncertain than it was in the past. So from the surface, it looks like the Chinese government is really concerned with Alibaba acting like a bank without being regulated like a bank. So it's still not entirely clear what's going to happen with this business going forward. There have been a few announcements recently that Ant Group will be able to continue its operations in its lending business. But first, they'll basically need to create a new financial holding company, and then Ant Group is going to have 50% of control of that company. So fundamentally, it looks like Ant Group is going to be able to continue to offer the same services that they were able to before their failed IPO attempt. It's just that it will now be more regulated, but we'll have more information to come in the future. Okay, that's all I wanted to cover for Alibaba's core businesses. Now let's send it over to Frank, where he can walk us through his valuation for Alibaba.
Thanks so much for breaking that down, CJ. Now we're going to jump into a bit of a valuation. So an important part for the valuation of Alibaba, or any company for that matter, is the comps. And honestly, for Alibaba, it is hard to find a company that is very similar to Alibaba because it's such a unique business. But let's start with a quick comparison to probably the most obvious choice, which is Amazon. So just looking at these two charts, we can see at the top that the PE ratio for Alibaba is 26 compared to Amazon in the orange, which is 62. Move down to the bottom chart and we can see the enterprise to free cash flow ratios, where Amazon is at 72.1 compared to Alibaba at 16.3. Now, when two similar businesses have such a difference in value multiples, there's usually some type of reason, like maybe the debt or possibly growth. But if you look at this chart, we can see the enterprise value to net financial debt for Alibaba and Amazon, where Alibaba up the top is trading at -11, and then we see Amazon down the bottom at -36. So for Alibaba, that is trading significantly cheaper than Amazon, is actually in a better financial debt situation than Amazon. So the other consideration, of course, is the growth. But as you can see in this table, for the revenue growth year on year, Baba and Amazon are about the same at 40%. If we look at a forward basis, Baba slightly outperforms. Over the 3-year CAGR, we're looking at outperformance from Alibaba being 42 compared to Amazon at about 30. And then the 5-year CAGR, Baba at 48% compared to 30% for Amazon. So not only do Alibaba come across as cheaper on those multiples, they also seem to be in a better situation with debt and possibly even growing better than Amazon as well. Okay, so now I'm going to add in a few more companies for comparison. In this chart, you can see that I've also added in Google and Tencent for comparison. You can see Amazon up the top is trading for 52 times unlevered free cash flow. We have Tencent trading at 48 times, Google at 36.4, and then well and truly cheaper down the bottom is Alibaba at 16.7. So now we've added in two more similar companies, and for an unlevered free cash flow basis, Alibaba is still trading much cheaper. Now I just want to show you those same comparisons, the same businesses, but all the way back before the pandemic. So we're looking at January 2020. So in the chart here, you can see that Tencent were trading at 44 times earning, and second most expensive using this multiple at the time was actually Alibaba at 40 times earnings, then Google at 39 and Amazon at 25. So over the past 18 months, you can see that Alibaba has become much cheaper. And over that time period, really nothing fundamental about the business has changed. And they've actually grown better than those other businesses that we are comparing them to. So now let's jump over into some of the spreadsheets I've made to have a deeper look at these comps, as well as eventually move over into the discounted cash flow. Okay, so first I just want to run you through some of the historical growth and the return on invested incremental capital. So I'm looking at per share growth mostly, which is the darker green lines in this table. We can see our sales per share since 2012 has compounded at 45%, earnings per share at 48%, cash flow at 40%, and free cash flow per share at 41%. So of course, since 2012, this is very impressive growth for a company. I don't, however, expect the growth to be this great into the future, but if this is any indication, it certainly is a positive sign. But of course, as a company gets bigger and matures, it does become harder to grow. Down the bottom, I'm having a look at the return on invested incremental capital. So you can see just down here that their reinvesting rate is just over 100%. We're looking at a return on incremental invested capital of 23.84%, which gives us a value compounding number of 24%. Now, this is essentially what I think the business might be able to grow at moving forward. However, I am being a bit more conservative just because of how large this business already is. But I'll come back to that later as we move on to the discounted cash flow. For now, let's have a look at some of the comps in a bit more detail and actually have a look at a multiples analysis for some of their competitors. So the companies I'm looking at as comps are Google, Amazon, PayPal, Facebook, Apple, Tencent, and Microsoft. I've left out Pinduoduo and JD.com as some of their multiples, particularly Pinduoduo being negative in earnings, kind of throws out the mean and medians for our comparisons. But of course, it is a fair comp that you could consider as well if you wanted to go in a bit more detail. but these are the companies for my comparison today. I'm looking at 3 multiples in particular, which is the price to sales, price to earnings, and price to free cash flow. And you can see all of these companies' multiples over the last 12 months. We have a mean and median for each of these multiples, and then in the blue here we can see Alibaba's numbers. And then I've gone down to calculate the percentage below mean for Alibaba and the percentage below median. And of course that's the most important numbers to take away. So for price to sales compared to these 7 other companies, these tech giants, Alibaba is trading 40% below price to sales on a mean basis, and then for the median it is 43%. If we move over to earnings, they are 39% below the mean and 23% below the median. Then finally, arguably most important, the free cash flow number, they are 53% below the mean and 43% below the median. Now we can think of this as some type of upside. If you think these comparisons are fair and that the market will eventually re-rate to the same types of multiples that we're seeing for these other companies, we have about a 40% upside for Alibaba just from that re-rating alone. Now let's jump over into the DCF. So I'll just explain some of the inputs that I am using here. I have the trailing 12 months free cash flow number, which has been converted into US dollars. Then I'm using the net debt. I have discount rate at 10% and an exit multiple at 15. So that exit multiple might be somewhat conservative if we're looking at their competitors, but I don't like to use an exit multiple any higher than that when I'm looking at 10 years into the future. The growth rate I'm assuming are for the first 3 years, I'm tiering them after each 3 years, is 20%. If we're looking at the growth and the value compounding number I talked about earlier, it implies they could grow at possibly 24%. I'm rounding that down to 20% for simplicity, but also just to be a little bit more conservative. For the next 3 years, from years 4 to 6, I've rounded that down to 10%. Now this is very conservative compared to historic growth, but as the company gets larger, it will be harder to grow and reinvest and generate the returns that they have. So I'm assuming growth slows down a fair bit. And then from year 7 to 10, I'm going down much further again to 5%, which of course is very low, but at that point they would be a very large company. That gives us an intrinsic value of $799 billion US, which is a margin of safety of 39.3%. Jumping back to the comps quickly, that does match up with some of these numbers we're looking at how much they're trading below their competitors. So 39% is obviously a great discount.
Thanks a lot, Frank. That valuation was really insightful and gives me a lot of hope for the future of Alibaba, that's for sure. I want to give a big shout out to Frank for coming onto the channel. I really appreciate the work that you put in to make that valuation for Alibaba. If you haven't already, please pop over and subscribe to Frank's channel. He explores in depth a lot of companies that he holds in his portfolio. He's very transparent and very thorough in both his analysis and valuation of the companies. I'm a huge fan of his channel, and I'm sure we'll collaborate a lot more in the future. So let me know down in the comments below if you like this collaboration and if you learned something about Alibaba or its valuation. If you like this video, you may like my curated playlist of all things Alibaba that I've put together over here. Otherwise, please like the video and subscribe to the channel if you found this useful. I thank you so much for your time. Thank you for watching this all the way to the end, and I will see you in the next video. Thanks again for coming on, Frank.